Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome to the airwaves of the Voice of the Cape. You've just tuned in on 91.3 FM stereo, 89.8, 90.9, 95, but as well as www.vocfm.co.za. My name is Mohammed Hussein Peterson, and welcome to another Matric revision session, which is also streamed live on Facebook. That's live on Facebook and YouTube, on the VOC Facebook and YouTube accounts, and you're welcome to check it out. My name is Mohammed Hussein Peterson, and welcome to another Matric revision session, which is also streamed live on Facebook. That's live on Facebook and YouTube, on the VOC Facebook and YouTube accounts, and you're welcome to check it out. My name is Mohammed Hussein Peterson, and welcome to another Matric revision session. Yes, and which of course we look forward to. Faisal, thank you so much for joining us, and we look forward to obviously another exciting session. Today we're speaking about accounting, something that's very important in our lives. When it comes to money, I think we as a community are very much interested in how we can structure our businesses, structure our lives from a financial point of view. It's also for all of those small businesses, it's very important, but the starting block is learning how the money works, and basically, in a sense, how the economy works on a micro level. So we look forward to the session. Of course, without further delay, we'll be handing over to you to proceed, inshallah.
Thank you for that introduction. You are 100% correct. Everybody should know almost like how to do basic accounting, basically, and that is what our Department of Education is teaching us on grade 10, 11 and 12 level, to understand a business and how the transactions flow on a basic level. So without further ado, today we will be focusing basically on the accounting grade 12 in preparation for the matrics for the upcoming exams. We'll be focusing specifically on the balance sheet, the equity and liability section of the balance sheet, where a few questions that are guaranteed to be answered is questions like draw up a retained income account note, or draw up a retained income or a share capital note, for example. So for today, we'll be focusing on the retained income note, the share capital note, and obviously we also will be focusing on the liability section, but specifically the loan adjustment. We find that students struggle a lot with the loan adjustment. That's why the focus today on the liability section will be the loan adjustment. Okay, so let's get into the ordinary share capital account. So when we look at the question specifically, this question is extracted from the November 2018, the DBE accounting paper. It is also to be found on the Western Cape Government website for free. So a question, we will be looking at November 2018, question 3.2.2 and question 3.3.3 specifically. So the first one of 3.2.2 asks, draw up an ordinary share capital account. Now students, it is very important, during the lesson I will also pause and give some exam technique. It is very important to read your adjustments properly. There is no point in just scanning through the stuff, going through the stuff quickly and missing out the specific and important information. It is also very important for us to understand and know the format of the specific notes and the balance sheet that we are drawing up. Okay, so let's kick into the ordinary share capital note. So if we look here, we'll see here that we are given specific information to draw up the ordinary share capital note and the retained income note. So if we look at our adjustments, so on the one side of the screen, you'll see the list of balances. At the bottom, you'll see the questions. And on the other side of the screen, you will see the specific adjustments that is asked. So for the ordinary share capital, we will focus on letter G, which says share capital and dividends. Okay. So if we look down, we will see that we need to draw up an issued share capital account. Now we notice here that it says that we've got 1.6 million ordinary shares that are authorized. An authorized share and an issued share are two different things, completely two different things. The authorized share means that that's how much shares is available to the public or to the shareholders for issue. The issued share capital is the actual number of shares in issue. So the first thing we need to know is we need to know our format. So what we're going to focus on is on the first part is the open balance. Once we know the opening balance, we need to go find out what it actually is. If we go up, we see here that the adjustment says on the 1st of March 2017, 80% of shares were in issue. So if 80% of shares of the ordinary shares were in issue, the calculation will be as follows. So of my authorized shares of 1.6 million, 80% was in issue. So we times it by 80%, divided by 100 to get a percentage, obviously, or to get the total. And then we take out our calculator. We'll see there 1,600,000 times 80%, and then we'll obviously have an amount of 1,280,000. So students, the 1,280,000 is the number of shares that are actually in issue. So we write in here 1,280,000. Okay, carrying on from here, we need to go find out what's the money value that 1,280,000 shares represent, and where do we find that? It is not anywhere in the adjustments, so we need to go look at our list of balances, and we'll see there that on the 1st of March 2017, our ordinary share capital is 6,976,000. So by opening balance, we'll put in here 6,976,000 in there. Okay, next one. So people, very important to know the format. If we're not going to know the format, we're not going to know what we're looking for, right? So the next part is shares repurchased. Okay, so the shares repurchased, we write there shares repurchased. Okay, so in our adjustment, it says there the following. It says 300,000 shares were repurchased at a price of 465,000 above the average share price. Okay, so when we're looking at the above the average share price, people, we need to understand the following. That when a repurchase takes place, it is split into two accounts, right? So the price you pay, so the total paid, is split between two accounts. It's split between an ordinary share capital account and it's split between a retained income account. So we need to calculate here the average share price, and the average share price will then go into the ordinary share capital account, whereas the difference between the total paid and the ordinary share capital will be the amount that's coming out of retained income. Also remember, you need to put brackets in your question, or while you're answering the question, where applicable. No brackets, no marks. The examiners or the markers are very strict about this when marking your paper at the end of the year. So when shares are repurchased, we need to calculate what is an average share price. So I made up this formula that actually works. An average share price, you will always use the following. It is the number of shares, or the rand value of the shares just before the buyback, divided by the number of shares just before the buyback. So my calculation will be as follows. So the buyback took place on the 1st of May. So it will be the number of the money value of the shares before the buyback, which is 6,976, divided by the number of shares before the buyback, 280. And if we put that in our calculator, we'll find that the answer should be, so let's check, 6,976 divided by 1,280 the answer should be 5 Rand 45 per share, which is the average share price. So we've got an amount here of 5 Rand 45, the average share price. So now I need to say I'm buying 300,000 shares back. So I need to say, okay, 5 Rand 45 times 300,000 shares, and the total amount that I'll be buying back will be 1 million, or the total amount that I'll be spending for the repurchase of the shares will be 1,635,000. People, I again emphasize, brackets are very important. You can have your entire calculation right. If you don't put the brackets in, you're not getting the marks at all. So we put in here 300,000. Okay, so the next part is obviously the issue of shares. Okay, so as we can see now here is that my balance at the beginning of the year minus my repurchase of shares plus the issue of shares would give me the balance at the end of the year. So basically what you have to do here to find out the number of shares that you issued and to find out the Rand value of the shares that you issued, we need to work backwards and basically mathematically solve for X. Right? So all that we do is we say, okay, 1,280,000 minus 300,000 plus X mathematically is equal to 1,480,000. Therefore, my X value will be 500,000. If you put it in a mathematical formula, you should get 500,000. For exactly the same thing you put on the other side for the Rand value, you say 6,976,000 minus 1,635,000 plus X is equal to 8,816,000, and your X should be 3,475,000. So that wraps up basically the issued share capital note. We will now go over to the retained income note to see what to do over there. Okay. So basically, people, the retained income note is basically calculating, the purpose of the note is calculating after everything is paid, how much money is left over into the business at the end of the financial year. The reason why people calculate retained income, so they know what is left. Can the money be invested back into the business? Should we maybe pay out more shares, etc., etc.? So let's go on. Again, we emphasize on the format. Very important to know the format of the specific note, because in a test they normally just give you the note just like that, where you need to put in the format yourself. I've seen in tests before that you also get marks if you put in the format, if you know the words regarding the format, etc. Okay, so we're starting off with a balance on the 1st of March 2017. So at the beginning of my financial year that I'm currently working with, I have an opening balance of retained income of 376,600. Okay, so the first thing in the format we'll do is we'll always have what is my net profit after tax. It will always be the amount after tax. So very important also, people, to understand is that when you study or when you're going over specific questions or principles, I need you to, or it is better for you to understand the concept and the principle being applied to the question. I always maintain there is no point in doing 100 questions, but we don't understand the principle and the concept regarding that specific question. So rather do 5 or 6 questions, but understand the principle. So the net profit after tax. So let's go see what our adjustments tell us regarding net profit after tax. So if you look at letter F, it says income tax for 2018. It tells us there that 31,300 is still due to SARS. So that means it's an amount that is due to SARS. It will form part of the liabilities in a balance sheet, because we still need to pay SARS that amount of money. The next bullet says the correct net profit after tax is 959,400. So this specific question is giving you the net profit after tax. Whereas some questions you have to work out the net profit after tax. So very important is to understand how to calculate the net profit. So for the purpose of this example and this question, we'll just follow this. It says the correct net profit after tax is 959,000, and we'll put it in there, 959,400. Correct. Okay. The next part says number of the repurchase of shares. So, if you can remember earlier what I said that whenever a business repurchases shares, the amount paid is always split into two. It will be split into an ordinary share capital note and a retained income note. That was point number one. Point number two I made is, then we will need to calculate what is an average share price. We said that the average share price is taking the rand value of the shares just before the buyback divided by the number of shares or the unit value of the shares just before the buyback. And then we'll get the average price. The average price then we multiply it by the number of shares that we repurchased, and then we get the rand value. Whereas when we're looking at in the retained income account, whatever the difference is what we're going to put in the retained income account. In other words, whatever the difference is between what we paid for the number of shares and the ordinary share price becomes the amount that we're taking out of the retained income. Now, for the purpose of this question, they are giving us here that on the 1st of May 2017, 300,000 shares were repurchased at 465,000 above the average share price. So therefore, we don't need to actually work it out. They're telling us there that the amount that is coming out of retained income is 465,000. So what we do is we enter into our retained income note 465,000. Students or listeners, remember that no brackets, no marks. Very big emphasis. I emphasize a lot on this. Reasoning is because a figure that you put in can be worth 4 to 5 marks in a paper, and if you don't put in the brackets, then all that 4 to 5 marks is lost. That's exam technique. We need to understand this. The next part of the retained income note would be the ordinary share dividends. So we know that in one financial year, we will issue or we will declare an interim dividend and a final dividend. So an interim dividend will always be declared and paid, whereas a final dividend will only be declared. Very important to understand the difference between the two. An interim dividend is declared and paid, where your final dividends will only be paid. Your final dividends will only be declared. It will not be paid, and therefore will need to be disclosed in the balance sheet under the liability section as a liability, because technically you still owe that money to the shareholders at financial year end. Very important to understand these principles and concepts, people. The example that I'm using is just for the purpose of giving you an example after my explanation. I need you to take away from this lesson or from this session the principle and understanding of the specific adjustment. Okay, so let's calculate the interim dividends. So we know we need to say, how do you calculate an interim dividend? It is the number of shares, right? A number of shares that are entitled to the interim dividend times the dividend issued. So let's go back to our question. In adjustment G says the following: interim dividends paid 30 cents per share. So there was 30 cents per share that was paid on interim dividend. But how many shares were there? So we'll see that before the interim dividend was paid out, a repurchase took place of 300,000 shares. Again, I'm emphasizing, do not forget what you did before in the question, because it is like a building block. Okay, so it says there that 1,280,000 shares were issued at the beginning of the year. You therefore repurchased 300,000 shares, and then you issued a interim dividend. So how much shares are entitled to the interim dividend? How much shares are entitled to that interim dividend? So you'll see the following. We'll see that. So what we'll do is we'll take the 1,280,000. We then subtract the 300,000, because those are the number of shares we repurchased. We then get to a value of 980,000. Right? What we do now is we say 980 times 30 cents, 0.3, and that will be your interim dividend. So if we take our calculators, we say 980 times 0.3, we'll get 294,000, which is your interim dividend. 294,000. Okay, so the next part we need to calculate is the final dividend. But also, people, what I've noticed in papers, in a few or a lot of papers that I did before, they want to know, do you understand the mathematical flow or the way the note or the income statement or the balance sheet flows, right? So we know that the balance at the beginning of the year plus our net profit after tax minus the repurchase of shares minus the ordinary share dividends will give us the balance at the end of the year. And if you look in your list of balances, they give you the balance of retained income at the end of the year, which is 384,600. So if we can go put the balance at the end of the year, 384,600. 384,600. So like I said before, balance at the beginning of the year plus net profit after tax minus shares repurchase of shares minus ordinary share dividends gives me the end of the year balance. So I can now work backwards to find out what is this amount over here. I can work backwards to find out what is that amount over there by basically making this X again. So basically this is what I'll do. I'll say my opening balance 376,600 plus 959,400 minus 465,000 minus X is equal to 384,600. And then you just solve for X, and X will be, if you put that in your calculator, X will be 486, 400. 400. Okay, then we've got a final dividend. So we know that interim dividend plus final dividend is given, it gives us a total dividends, which in other words, if you take the final plus the interim, it should give us the value here on top. So we can just say the 486,400 minus the 294,000 will then give us an amount of 192,000. So let's just check here, 192,000. So students, grade 12s, that is how a retained income note is drawn up. This specific paper is November 2018. You can get it off the WECD website for absolutely free. You can download the solution, you can download the question paper, and you can download the answer book to the specific question. Next, we will be we'll be focusing on the loan in a balance sheet, the liability, the non-current liability, a loan in the balance sheet. So when we look at so specifically this, before we carry on, let's just explain the principles of a loan. Now, students are getting confused. We need to understand the following, that a loan, right, is always split into two. A loan is split into a long-term portion and a short-term portion. Okay? Very important to understand the following. When we split our long-term portion and the short-term portion, we need to make sure that whatever amount we pay in on the loan within the next financial year will be the short-term portion. The question paper should indicate or should give you a clue or should lead you in that way for you to work out what is the short-term portion. We would then subtract the short-term portion from the loan, and the difference will be the long-term portion. In other words, to make it simpler is, if my financial year ends on the 28th of February 2017, right, what amount will I be paying from that date within the next financial year? So in other words, 12 months from that date, what amount will I be paying? And that amount would be my short-term portion. Whatever amount I'll be paying beyond the next financial year will therefore be part of my long-term portion. The question, a paper that specifically want you, the principle we test in here is, can you distinguish, can you calculate the difference between a long-term portion and a short-term portion, and can you disclose it, can you put it in the balance sheet in the liability section as such? That is the principle here. Okay, so the next part of the loan that students struggle a lot with is when the question says interest capitalized. What does it mean when interest is capitalized? It means the following. It means that you are adding your interest back to your loan balance. So let me just give you an example, a quick example, just to understand it quickly. You go to the bank manager, you ask Mr. Bank Manager, can I please borrow 50,000 Rand? The bank manager tells you, yes, no problem, here's 50,000 Rand for you. Okay. But you're going to have to pay a 10% interest per annum or every year. Right? This is just an explanation to explain interest capitalized. So every year you're going to pay a 10% interest. However, you agree with the bank manager that you are also going to pay 5,000 repayments every year. So let's see what happens after year one. So after year one passes and you have to pay interest. So you're going to have to pay 10% of 50,000 is 5,000. And you're going to have to pay the repayment. Or let's say the repayment that you have to pay is actually 6,000 and not 5,000. Okay. So interest capitalized means the following, that whatever interest you accumulated over that 1 year, or whatever interest you accrued, rather, the proper word would be accrued, because you have to pay it to the specific financial institution that you are borrowing from. So if you accrued 5,000 interest on the 50,000 Rand that you borrowed, it means you are adding it back to the capitalized, plus 5,000 Rand, you now owe the bank 55,000 Rand. Then the payment takes place. You agree that you're going to pay the bank. We said we're going to change it from 5 to 6,000. You agree you're going to pay the bank back that. Then you say minus the payment, 6,000, and you now owe the bank 49,000. That's what's happening here. Then we carry on and we say the following. After year 2, what happens? So year 2, we must say that we must pay 10% interest. So you plus 4,900. So we're going to say in our calculator 49 plus 4,900 we get 53,900. 53,900. Then we make a payment of 6,000. So now you owe the bank. So for 53,900 minus 6,000, and then we owe the bank 47,900 after year 2. 47,900. So the principle that I'm bringing across here, people, is to understand what does interest capitalized mean. It means that you are adding your interest every year back to the bank balance. So let's go to the question and go and see what specifically would we do in this specific question when determining what interest capitalizes and splitting the loan between the long-term and the short-term portion. Okay, so we'll see here that if we look at our question, we'll see that the long-term portion or the total loan would be, so it says your fixed monthly repayments include interest of 31,600. Capitalized interest amounted to 242,500 for the year ended the 28th of February 2018. Interest for the next financial year is expected to be 162. Part of the loan will be repaid within the next financial year. Okay, so this is what I want to do. My total loan is the following. The total loan that I've got is 1 million. If I look in my list of balances, you'll see there 1,725,500. Okay, you then need to subtract your repayments for the financial year, which is 379,200. And how do I calculate that? You'll see there it's 31,600 per month, and if you times it by 12, you should get that amount. I then add back my my interest of 242,500 because interest is capitalized. Okay, so if I know this is my repayments for the month, right, including interest, or yeah, this is my repayments for the month. Let's just check if it's included interest, yes or no. 31,600, yes, it is included interest. What is going to be my loan for the next financial year? Okay, so I need to say 379,200 minus 162, right? And then I'll get 217,200. The 217,200 students is what is going to be my short-term portion of my loan. Therefore, I need to subtract 217,200, and this is the short-term portion. And the balance would be the long-term portion. So if I work it out, my long-term portion in my loan will be, so to be loan, it will be the long-term portion will be 137,600, and my short-term portion would be the 217,200. And that, students, that is how you calculate the long-term and the short-term loan.
Well, I want to say a big shukran to our guest today, who was taking us through the accounting paper 1. Of course, Faisal Ibrahim, shukran so much for joining us, and we look forward to next week when we have another session with you. And of course, if people want to get hold of you, email that they can contact you on.
My email address is fzlibrahim, EBRAHIM @gmail.com. And you can also contact me via WhatsApp 0766 137047.
Fantastic. So that's Faisal Ibrahim. Contact him if you require any tuition. This video will be up on Facebook and YouTube, so you can go back and check it out. That's it for our matric revision program for today. Time for us to take a break. Thereafter, we'll have the news at 4. And don't forget drive time between 4 and 6. Stay with us. From myself, Muhammad Fasik Peterson, I bid you assalamu alaikum wa rahmatullahi wa barakatuh, and have a safe day further. Inshallah, I'll be back with you this evening between 6 and 7.
The Voice of the Cape, 91.3 FM.